Welcome to the Furlo Capital Real Estate Podcast, where we talk about the intricacies of passive real estate investing. And our mission is to equip people to invest wisely in both properties and people so that together we can build our wealth while improving communities. I'm James, and this is my wife, Jessie.
I'm here, and it's baseball season.
It is baseball season.
If we ever get to play baseball. I was scheduled, so I guess games haven't started yet.
Correct. Those start in May.
Right. And for our son. I mean, I have no idea about, like...
Real baseball? Real baseball's already started.
All right. That's what I figured.
Or it's spring camp or spring training or spring ball. I don't know.
Recruiting or whatever.
It started.
Anyways, it's baseball season. So I was like pumped to take Samson to practice, and it got rained out. And I'm like, we live in Oregon. Like, when are you ever going to play baseball if you cancel everything when it's raining in the spring?
Well, the hard part isn't necessarily the kids. It's the fact that it will destroy the field.
Yeah.
And you just don't want a bad field.
I'm like, let's put in some AstroTurf so we can actually play some baseball.
Yeah, just talk to the city and tell them to get on that.
Yeah, right. Well, we are talking about taxes. I mean, this is different.
We are talking about taxes.
I feel like taxes could be used for that.
Yeah. I'd rather them not, but
this is your son we're talking about.
Taxes. I don't know. He'll survive. Make him a muddy mess.
He'll survive.
Yeah, I played on a regular field, so it's all good.
Yeah.
But yeah, we are going to talk about taxes because I had a really interesting conversation earlier in the week where I learned something. And that doesn't happen very often.
Imagine that.
No, I know.
You learn new things all the time.
Yeah, I do. And so I just wanted to share it because I like to think that I know a lot about real estate and the numbers behind it.
Yes.
And this one, somewhere I missed it altogether.
Okay.
And I was totally surprised
by
it.
This is not like a new tax code or something like that. This has been around for a while.
No, it's been around for a very long time.
Okay, all right.
Yeah. So here's the situation. I'm considering selling one of my buildings.
Yeah.
Set of warehouses. It's on I-5. It's got a super sweet mural with a bald eagle
looking.
And an American flag behind it. I'm hopefully by the time this airs, I've already got it under contract and we're moving forward. That'd be awesome. But when I bought it, I did a 1031. Okay. Mm-hmm. And here's where things get a little bit complicated. So we owned 3 other properties. And those properties all went up in value, and you got to pay taxes on that value typically when you sell.
Right.
But
capital gains, right?
Capital gains.
I understand that.
Yep. And so you can, instead of paying your taxes on those gains, you can roll those into a future property and just kind of keep rocking and rolling. And the game that some investors play is they never outright sell. Mm-hmm. And so they always because once you die, it kind of everything gets reset for your kids essentially, which is super nice. And so then they can sell and they don't have any capital gains technically. It's one of those legal tax loophole things that help the wealthier get wealthier type things. Mm-hmm. So here's what I learned. Super interesting is, so we bought those properties and we had about $200,000 worth of equity in each one.
Okay.
And so I was able to roll $600,000 into this warehouse. And so even though I bought it for like $2.6 million, it was as if I bought it for $2 million. It's kind of the math to think about it. So I already had a built-in $600,000 worth of equity carryover. All right. Essentially, kind of how to think about this. And so then if I were to sell that one outright and just do nothing with it, and so it would be the delta between the new sales price and essentially 2 million, not the 2.6. Roughly speaking is how to think about it. So here's what I learned, because with this warehouse, I also have a piece of land, which is technically separate and was outside of this initial exchange. So when I rolled over that 600,000, I did that to the warehouses, and then I separately bought a piece of land and didn't roll anything over. It wasn't part of this exchange thing. And so we were talking with them, and I was like, well, it'd be nice to take out some cash from this and not just roll over 100% of it to give us some working capital to do some other projects and things that we want to do. And so the question I had was, okay, how do I structure this to minimize my taxes? And I talked to a CPA, and it was really interesting because I was like, does this even matter? Like, can I just bundle them all together and just sell it all as at one and just pay my capital gains tax as is? And he went, I would not do that. And I was like, I don't know. Okay, cool. Tell me more. He goes, you want to separate these things out, and whatever cash you take out from the land.
Not from the 1031.
Not from the 1031. And here's why. I didn't know this. So that $200,000 in each property there's two parts to it. There's the value of the property went up, but then there's also depreciation that happened. Okay, so, all right, so stick with me. I'm going to use a hypothetical example here just to kind of help us out. Mm-hmm. So we bought our very first duplex for, let's just say, $200,000. I'm going to round here just to help out with the numbers. We bought it for $200,000. We then sold it for, again, I'm going to exaggerate some numbers to help this work, okay? We then sold it for $350,000. Okay. But in that process, we had depreciated $50,000 from the property.
Okay.
So is that math going to work for me? No, that math isn't going to work. How do I want to think about this? Okay. Another way to think about it. So bought it for $200,000, sold it for $400,000. Mm-hmm. And that's that $200,000 that was in there, right? That's that $200,000 of capital gains that we were talking about.
That you could roll over.
That I could roll over.
Mm-hmm.
Well, it turns out that's not the only thing that rolled over. That was the cash that I was able to apply to roll over.
Okay.
But there was also depreciation that happened in that property in the time that we owned it.
Okay.
And so even though we bought it for $200,000, it was as if, and here's where I'm going to exaggerate some numbers just to make it easy. It was as if we had depreciated $50,000 for it. And so what actually rolled over from a tax perspective wasn't the 200, it was 250. Does that make sense? From a tax perspective.
Okay.
The cash was 200, which is what I ultimately used to buy the place.
Yeah.
But there's this phantom depreciation that continues to carry over. So here's what's interesting. Let's pretend there's no 1031 at all that happened. Okay. And let's just say we bought that duplex for 200 and we sell it for 400. Okay. And we had depreciated $50,000 throughout the life of that investment. Okay. Here's what's interesting. That first 200 capital gains is taxed at the capital gains tax rate of 15%. But that depreciation, called depreciation capture, is not taxed at the capital gains rate. That is taxed at your ordinary income rate at a max of 25%. So let's say that you're a high income earner and your normal tax rate is 34%. That $50,000 recapture is taxed at, in this case, it would be 25% because it's that max amount, not the 15%. Okay, you're giving me squinty eyes.
Yeah. I just don't understand why they tax depreciation. Doesn't make any sense to me. Because depreciation isn't income. I mean, maybe from a tax perspective, they count it as income.
Well,
it's as if it were.
It is. So what it does is it offsets your regular income okay, good. Okay, I see where you're going with this. So during that time where you depreciated the $50,000, you had tax returns and you were paying your taxes. And what they were doing is saying, hey, you had a job. Congratulations. You had to pay taxes. But then you went, oh, but I had depreciation, and it decreases
the amount of taxes you had to pay.
Yeah. And so it's essentially, it's rebalancing that out. So when you pay depreciation, or when you take depreciation, here's what I'm learning throughout this whole process. And again, I don't know how I missed it, but whatever. It's as if it's an expense, but, and so you get to treat it as such. So you pay less in taxes because you had a bigger expense. But then when you sell, they're like, well, we want to that expense now, it reconverts into income. And you have to pay for it. It's an interesting,
I didn't realize that's how depreciation worked.
I didn't realize that you were taxed at the ordinary income tax rate. That, to me, was the surprise. I always thought it was all going to be, considered capital gains at 15%. I was like, oh, this is an extra 10% here that I got to think about. Plus whatever Oregon's
But only on
taxes.
The depreciation amount.
Only on the depreciation amount. And what I'm still trying to square... My CPA didn't have a great answer for me. I said, well, there was this whole bonus depreciation thing that everyone was getting all excited about. You can depreciate up to 100% of the property at once in a single year. Yay! I was like, that sounds great, but you're
Except
telling
on
me...
the flip side.
Yeah, when I sell, I got to pay all that back, and that could dramatically change it. And he goes, well, He goes, that is even more nuanced than what everyone's saying, because what he's talking about with bonus depreciation is like, it's not just on the entire building. It's like, he goes, that's way more complicated on what that is. And I was like, that's interesting that it's not the panacea that everybody thought it was, outside of the thought being, well, if I save the money on the taxes now, that gives me more money to invest now.
Today.
And so if I can get a higher return, cumulative return, than what I would pay on taxes, then it's totally worth it.
Seems like such a game to play, though. I mean,
Right?
that's the whole thing that I didn't like about considering depreciation when we were initially investing, because you were like, oh, there's this other magic number here that you can factor in and it makes the property look better because you can lower your expenses. And I was like, no, I kind of like, let's take that out of the equation for a minute.
Yeah.
Does it make money without that magical thing?
Yeah.
Because then it will be even better if it does.
Which, by the way, I still underwrite it that way. I still don't consider it, but mostly because now it's all about on your personal taxes, like it's not necessarily the property itself.
Yeah,
it's super interesting.
Just offsetting expenses.
You are required. There is a minimum amount of depreciation that you're required to take. You don't have a choice.
Sure.
But if you wanted to do more, government would let you.
Huh.
It's kind of
okay, so for this 1031 thing.
So yeah. So here's the relevance behind it. So thank you for that.
I'm still going, okay, like back to the warehouses.
So let's just say we want to take out $100,000 to do something with it, right?
Yeah, reinvest, whatever.
Get a new roof or something on this house, whatever. What he says is the way that it works is how do I want to say it? They start with whatever the biggest tax thing is first.
Ooh.
So
you pay taxes on the depreciation
because I was like,
first.
I was like, well, I'll pay my capital gains tax on the $100,000. He goes, no, you won't. You will pay the depreciation recapture first, and then if there's any left over, you'll move into the capital gains rate. And so he's like, so you will pay the 25% on it. He goes, however, if you do the land, you don't depreciate land because in theory it never wears out. He goes, so you have no depreciation on the land. That would be the pure capital gains amount.
Interesting.
It's like, so whatever it is that you want to take out, sell the land for that amount and pay your 15% capital gains. He goes, that is your cheapest way to go. He goes, because if you bundle it all together, you wouldn't have a choice. You'd have to do depreciation recapture first.
If you have the warehouses and you're 1031ing, that I just made that a verb.
Yeah, sure.
If you turn 31 those into a different property, and you have the land, let's say you have the same buyer.
Okay, yeah.
Is it two separate transactions?
Essentially, yeah.
Interesting.
And I could take the land and like add it to a future, like I could 1031 the land into a new deal that is combined with the warehouses. Like I could,
like our 3 properties that we did together.
Correct.
So you could do both of those, and the value would go towards this other.
And if
property.
I wasn't taking any cash out, none of this would matter. They'd be like, "Yeah, I just bundle it all together.
Bundle
it doesn't
it
matter." But the fact that I floated the idea of taking some cash out, that's where all of a sudden everyone went, "Okay, hold on." Like how you do this is important. We're talking about an extra 10% in taxes here that you got to worry about. Yeah. Oh yeah, no. This is why you have CPAs and you pay them money to have conversations. Yeah, dude. I get it. It's a thing.
I didn't think I was going to understand that, but I understand the math.
That you did. There's one other interesting thing. No, I'm gonna let it go. I'm trying to think. Yeah, I'm gonna let it go. You cannot. I guess the one thing is if you're doing a syndication, you are technically not owning the property. You are owning a business that owns the property.
Right.
And so that whole idea of like 1031ing into a new thing doesn't exist.
Right.
The business could 1031 if you and all the other investors decided to stay. But if you are just like, if the business buys and sells, then all you're getting is income from the business. And it's not even a capital gains thing. It's, it is. But you don't have the option to 1031 because you don't own land or property. You own shares in a company. Now, the income is still capital gains or depreciation recapture. It's one of those two. But you can't 1031 it. which is kind of an interesting subtlety.
With this other property that you're working on, the pre-foreclosure that you're essentially flipping it. That doesn't count as a 1031 either, does it?
No, that is wholly separate because I'm going to own it for less than a year.
Right.
And so, yeah, so it's only capital gains if you own the property for longer than a year.
Okay.
If you own it for less than a year, they consider it as like inventory in a business.
Oh.
Yeah, and so you're taxed at like the ordinary tax rate.
So flipping
for a flip
is maybe better than...
It's more expensive from a tax perspective.
Oh.
Because it's ordinary income. So
not capital
not
gains.
Capital gains.
It's just...
Yeah, because ordinary income is going to be, what is it? Your 22%.
Your whatever tax
34%.
bracket you're in.
Yeah. Which for like what we're selling it for, it'll bump us to a higher tax bracket. So it's not as... And I had this problem when I was... Not a problem. Had this happen when I flipped the piece of land in Indiana.
Okay.
As a similar thing, it counts because I was like, "Oh, dude, I'll pay my 15% plus 9% to Oregon," and he was like, "Yeah, about that. Like you sold it too soon." And so there could be some strategies where you say, "Hey, I'm going to hold on to this thing for over a year, pay less taxes," but then you got to offset that with holding costs, both in terms of interest and all that other stuff and stuff. So I could see a strategy where you go, well, I'm going to buy it, turn it into a rental, hold on to it for a year or two, and then sell it. And then you're not losing money to the holding costs, because even if that's break even, that could be worth it. And you say, yeah, I'm going to save my 10% that way. Maybe. I don't think it's... Nobody does that, and so I don't think it's worth it based on what I've...
if plenty of people are
it's either... You're going to fix it and flip it, or you're going to turn it into a rental, and then you're holding on to it. You're in it to win it for a long haul.
Yeah.
That's been my observation.
That makes sense.
Yeah. But yeah, anyways, that's what I learned today. Just kind of or earlier this week. Just kind of an interesting, just an interesting new little wrinkle.
Glad you talked to the CPA.
I didn't know.
Just be like, all right, here we go.
Yeah, no, and he was definitely like, oh, this is why you call ahead of time. I remember I called the 1031 person, and I was like, hey, do you care? And she's like, nope, don't care at all. She's like, but you should probably talk to your CPA about this. I was like, oh, all right, cool. So
interesting.
So yeah.
There you go.
The more you know, right? That's G.I. Joe, right? That's half the battle. Knowing's half the battle.
Knowing's half the battle.
Yeah, something like that.
The more you know.
I feel
is
like
that reading Rainbow?
Is it? I don't think. We're going to let whoever's listening, you can look that up on your own. I'm not going to figure it out.
The more you know. The more you read, the more you know. I don't know.
Sure, that sounds reasonable. The more you listen to us, the more you know. Yeah. So thank you so much for listening to that relatively technical numbers deep dive. We really do appreciate it. And we would love it if wherever you listen to your podcast, you leave us a quick rating. That would be awesome. Again, thank you so much for listening, and have a great day.